Risk is inherent in any investment, but how much is too much? Jim Lineweaver is here to weigh in with 5 ways to assess your assets. Jim is a certified financial planning professional with the Lineweaver Financial Group. Welcome again to the show.
That's right.
Now, I know in all this financial world, it's good to maintain perspective, but you still got to maintain your awareness of the risks that you're taking with all of this. And from what I understand, the first step in making sure you know what your risks are is allocating your assets.
Yeah, this is where you want to look at the different buckets or places you're putting your money, like your sectors and things. So it's going to be made up of stocks, or maybe mutual fund-based things. It's going to be made up of bonds and cash. And you might also throw some alternative investments and stuff in there. It could be real estate, commodities, gold, silver, things along that nature. So that mix is the asset allocation. And from time to time, some things are going to be better than others. So you want to make sure that you do it correctly. But a good rule of thumb is just you use that 100 minus your age is all the amount of money that you really want to have at risk. So if you're 70 years old, you can have 30% of the portfolio at risk, and the other 70 should be something you can rely on, maybe good dividend producing or something along that nature, but usually it's less risk than the overall stock market.
Okay. Step 2 that you have is called riding the cycle, providing you have the time. I guess that's easier said than done, huh?
It is, unless you have that crystal ball, it's not always easy. But the cycle refers to how stocks and things actually cycle through time. So in periods of like rapid growth and inflation, you're going to want to be more in maybe equity-based things and things that can appreciate in value. But you don't want to be in bonds, because if interest rates go up, what happens? Your bonds are going to lose money. Whereas also if inflation gets too high, then what you may want to do is go into gold or maybe even some real estate and things to hedge your bets a little bit.
Okay, man, timing is not easy to do. So the step 3 that you have is small and value. So what does that mean?
Yeah, what it pertains to in investing is your small cap stocks or your smaller companies tend to outperform over the long term than some of your larger ones. And then also value-oriented stocks, so things that you're buying at a discount may perform better over time because it's a little cheaper on the front end and hopefully there's some appreciation there. But when you tie into some growth-oriented stocks, they can be, if you're catching the cycle right, they can be a little more predictable. So it just depends where you're at on that cycle.
Okay. Step 4 is sooner or later. So let me guess on this one. Short-term versus long-term investments?
You got it, exactly. And people confuse the two, because if you're in a low interest rate environment like we are today, what they're going to do is they may try to push the envelope to get a higher yield, but that really might need to go into a longer-term investment. And you got to make sure you don't mix the two, because if something happens in the overall economy, it could mess up some of your short-term reserves that you're trying to fall back on.
Okay. And step 5, core and explore. Sounds like you're going to go like cave digging or something.
Yeah, no, it's not your core of your body to stay in shape either, although that helps. But when it comes to your portfolio, your core, some people say, and the theory out there with managers is to say, just link the core of your portfolio to some indices like maybe the S&P 500, the Dow, or the NASDAQ. And then explore would be, where do you want to take a little more risk? And you can do that on the outer skirts if you want to really dive into healthcare or some other specialty sectors.
Okay, so this all sounds like you understand it, but not everybody may. So, and we just touched on the basics, but you have a seminar coming up, right, that people can come to and learn a little bit more.
Yeah, because you really want to dive into a lot more detail when you're looking at this in your portfolio. So we do have an upcoming seminar. It's actually going to be at our office in Valley View, and there's no cost to your viewers. It's on Tuesday, May 12th at 1 p.m., and also Thursday, May 14th at 6. They do fill up quick, so I'd recommend they give us a call as soon as possible.
Okay, sounds good. As always, great information. Now, when it comes to investing, you can't avoid risk entirely, but by using Jim's steps, you can manage risk to your benefit. To learn more, attend Jim's seminar or just give him a call. His number is next.
For more information, call the Lineweaver Financial Group at 1-888-313-4009 or click to www.lineweaver.net.